Okay. So after this market capitalization of index, price weighted index, and equal weighted index, uses and types of indexes. So rebalancing means what? These two terminologies you need to know here: rebalancing and reconstitutions. Okay. Reconstitution means, in an index, let's say Nifty 50, there are 50 stocks, 50 companies, right? 50 company stocks listed. Now when there are 50 company stocks listed, there can be 51st company also here. Okay, then 52nd company, then 53rd company. So let's say 51st company is Wipro. So now quite possible that this top 50 companies, the 50th one, okay, might have fallen down. The market capitalization might have come down, and this 51st company's market capitalization might have gone up. So now this deserves a position in the top 50 companies, and this 50th company deserves to come down. So that is called as reconstitution. Reconstitution means basically they will change the companies in the index. Okay, so how often do they do this? Like in India, they do this every 6 months. May and September they check, and then accordingly they reconstitute. Okay, that is called as reconstitution. This terminology is important one. So periodically adding and deleting securities that make up an index. Reconstitution. Then what is rebalancing? Rebalancing means in your portfolio when you keep adding and deleting securities, then it is called as to their target weights. That means based on, say for example, you have decided as per your goal 60% should be in equities, 30% should be in bond, and 10% should be in gold. Now so you had 100 rupees, so 100 rupees you invested 60, 30, 10. Then over a period of time, quite possible that this might have gone to maybe 80, this might have come down to 25, and this might have gone up to 11. So now the ratio has changed. Now it is not 60, 30 and 10 percentage. So again you have to change this ratio. Okay, whichever has gone really high, you might have to sell it to some extent, and whichever has gone down, you have to add some more in that one and bring it back to 60, 30 and 10 percentage. This act is called as rebalancing. It is to adjust the weights of securities in a portfolio to their target weights after price changes have affected the weights. Is it okay? Rebalancing and reconstitution.
Yes, sir.
Okay. Then some other terminologies here. Um, CAPM is a very important term, but right now it is not needed. Um okay, right now, or I'll just shortly explain. See, CAPM stands for, it will be coming again and again. Okay, very often I will be using this term. In other subjects, I will be highly using this term. But let me explain now also. Capital asset pricing model. Capital asset pricing model. Now, capital asset pricing model. Um, the formula is, see, CAPM, this will tell you actually what is the required return from your stock. That means how much should your company give you minimum. It will tell you what is the required return. What is the required return from your stock. Okay, its formula is risk-free rate. How much will you expect from your stock? Let's just think logically. Say for example, you have invested in, let's say, SpiceJet company. Now, when you have invested in SpiceJet airline company, this is an airline company. So, how much will you expect from this company shares? First of all, you will say like, look, Hello, hello.
Yes, sir. Hello.
I think in between you could not hear me, is it?
Yeah, no, okay. For few seconds.
Okay, okay. So did you miss out on anything?
No, yeah.
Capital, I said capital market, capital asset pricing model. Now, when you are investing in SpiceJet airline, how much will you expect? So you will say like, if you put this money into government bond, you will easily get maybe like 7%. So you will say like, I want 7% minimum plus. Then what? Then you will say, look, the market is giving, how much is the market extra giving? You will try to check. Market as in the overall index Nifty. So for example, Nifty has given 12 percentage. So that means Nifty is giving 5 percentage extra. Okay, this is risk free 7 percentage. So if Nifty is giving 5 percentage extra, I want that 5 percentage also. That means 7 percentage plus Nifty is giving 5 percentage. So I want that 5 percentage. So this is return from the market minus risk free. Okay, so 12 percentage you will expect. Also, you will say like, look, now index consists of all top companies, but SpiceJet comes somewhere over here. It's a small cap companies. Okay, it comes somewhere here, small cap companies. So I'm taking more risk than this company. So because I'm taking more risk, I want that also. So we will analyze how risky is this company. That is called as beta. Okay, that is called as beta. Beta will tell you uh, the market risk or the systematic risk of the company. So say for example, now how is this calculated? Don't worry about this. How is this calculated? Because we have other subjects to discuss that one. But this will tell you the sensitivity of the stock in comparison to the index. Okay, beta will tell you the sensitivity of the stocks in comparison to the index. Okay, so beta will tell you the sensitivity of the stock in comparison to the index. In comparison to the index. Okay, so that means if index is going up by 1%, then how much is the SpiceJet stock going up by? Let's say it is going up by 1.2. So it is riskier than the market. Okay, it is riskier. So if tomorrow index comes down by 1%, this will come down by 1.2%. So this is 1.2. Okay, now you just calculate this 1.2 in plus 5%, just calculate how much it comes to. 5% into 1.2. 5% into 1.2 is what?
0.06 plus
Uh,
7%. Right? It's 0.0642.
0.06 means 6%. Okay,
Yeah, 6.42.
6%, right?
6.42.
Acha, 5% into 1.2. It is 6% only, no?
So
Yeah,
the
it's just
final
point 6.
answer.
Final is 13, right?
Oh,
Final is 13.
5%.
Okay. Final is 13. You need to be little careful while
Okay.
calculating this, because the common mistake that people will do is they will take this number and then they will say plus 7%. That
Yeah.
means what will happen? System will take
Yeah,
seven
yeah, got
percentage
it.
of this number.
Yeah.
Okay, so you have to be, if it is confusing you, how you should add is like you change it like this: 0.07 plus 1.2 into 0.05. Okay, like this you do.
Yeah, got it.
Okay, so you should expect 13 percentage from size SpiceJet. Market is giving how much? Market is giving 12 percentage, but you should expect 13 percentage. Why? Because you are taking more risk than the market. This is called cap. Okay, very, very important one. Okay. Uh, so that's why this is one of the uses, so because market is needed, we have to find out the CAPM return. Okay. Uh, yeah, rest is not needed. This one. These are all very common points only. In this one, describe types of equity index. So, broad-based index, Wilshire. This has 5,000 index contains Wilshire 5,000 index contains more than 6,000 equity. Okay, and is therefore a good representation of the overall performance of the US equity market. So, Wilshire 5,000 index, it has more than 6,000 equity shares from US. Okay, then this is a popular one, multi-market index. That means MSCI. MSCI stands for Morgan Stanley Composite Index. Okay, Morgan Stanley Composite Index means this is like an index of index. Okay, it will have index of index. So, uh, yeah, so it will have index of index. Okay, multiple indices will be there. Then similarly, sector index means what? Particular sector it will represent. FMCG sector, pharma sector. Okay, FMCG sector, pharma sector, IT sector, banking sector, this way. Then style index. Style means large cap, mid cap. Those are all called style. Large cap, mid cap, small cap companies. It's called style index. Okay, so measures the returns to market capitalization or value and growth. Value means undervalued company. So these are examples of style index. Okay. Yeah, this is not needed here. All these are not needed. Describe types of fixed income. Is also not needed. Yeah, so all these are not needed. Okay. Hedge funds we will be doing in alternative investments. You don't have to worry about it. Real estate index, all this we will be doing in alternative investments. Okay. Even commodity index we will be doing in alternative investments. Okay, then next one. So key concepts also put the habit of reading. Okay, that is also a good one. Key concepts. That means it's a summary again. Then market efficiency. Yeah, reading 41 market efficiency. So this one, passive investments and active investments. Uh, passive and active investments. Okay. So any idea passive and active investments?
Passive is like when you don't trade actively, right?
Yeah. So why? Why don't you trade actively then?
Like it's for a longer term. So okay.
Okay. See, uh, in active investments, you want to beat the index. Okay. In active investments, okay, active investments means in active investments, fund manager wants to beat the index. Beat the index means he has to go ahead. He wants to go ahead of the index. Wants to beat the index. Okay. Fund manager wants to beat the index. Fund manager wants to beat the index. That means he wants to score more than the index. If index is giving 12 percentage, his target is cross beyond 12 percentage. Okay, take more than 12 percentage. Passive investments means All you want is to copy the index. Fund manager will invest as per the index. Will invest as per the index. Will invest as per the index and would want to make the same return as given by the index. That means if index is growing at 12%, he also would like to grow at 12%. If he is doing that one, then he is a good fund manager. He has to just copy index. Okay, that is passive investments. Okay, then uh, next one, intrinsic value. We will be speaking about it extensively. So right now it is not needed. Intrinsic, yeah, right now even this page is not needed. This page is very important one. LOS, lesson of study 41.D. This is an important one. So now here we are supposed to, this is one hypothesis. Hypothesis means general belief. Okay, general belief, general statement about something. General belief or general statement about something, that is called hypothesis. So that hypothesis we are going to learn now. Okay, so general statement about some, general statement about anything. Okay, so there is something, this concept is called efficient market hypothesis. Efficient market hypothesis, EMH. Under this we have weak form efficient market hypothesis. Then we have semi-strong form efficient market hypothesis. Then we have strong form efficient market hypothesis. Okay. So efficient form, weak form efficient market hypothesis. Okay. Here, under this hypothesis, one cannot make abnormal profit using technical analysis. What do you mean by technical analysis? That means historical data. Using technical analysis, one cannot make abnormal profit. Okay. If you still make, then you have you understood the statement what I have written here? Both of you are fine with it?
Yes, sir.
Yes, sir.
See, one cannot make abnormal profit using technical analysis. Why you cannot make abnormal profit? Because it assumes that everybody knows. When everybody knows how to use technical analysis, how to use historical data, then you cannot make abnormal profit. You can make normal profit, but you cannot make abnormal profit. But suppose if you still do it, if you still, try to do, if you still uh, try to make abnormal profit, if you still, still try to make, or if you still make abnormal profit, it means the market is inefficient. They will play with English in this topic. There are many questions, okay, in the curriculum. It means the market is inefficient. Inefficient. They would confuse you with this kind of words. Okay. In semi-strong, one cannot. So here, actually, here I should write another point also. Here, everybody knows about historical data. Everybody knows about historical data, and therefore one cannot make abnormal profit using technical analysis. Okay. Then here, everybody knows about historical and fundamental state, historical data and fundamental analysis, historical data and fundamental analysis. And so nobody can make abnormal profits. Nobody can make abnormal, both same sentence. One cannot make abnormal. Nobody can make abnormal profit using uh, using historical or fundamental analysis, using technical or fundamental analysis. Okay. If anybody uh, if anybody tries to, or if anybody makes if anybody makes abnormal profit, okay, if anybody makes abnormal profit uh, using semi if anybody makes abnormal profit in semi strong, if anybody makes abnormal profit, it means semi strong form. It means semi strong form of market is inefficient. Semi strong form of market is inefficient. Okay. Okay, next one is strong form efficient market hypothesis. So here everybody knows everybody knows technical technical analysis, fundamental analysis, and inside information. Inside information or private information. Okay, everybody knows technical analysis, fundamental analysis, and inside informations. Inside informations, and so nobody can make abnormal profits. Nobody can make abnormal profits. Okay, and here one can make abnormal profit. One can make abnormal profits using one can make abnormal profits uh, using inside information or private information. And here also one can make abnormal profits one can make abnormal profits using fundamental analysis and inside informations, that is private information. Have you understood this one? This is just a theory, actually, just a hypothesis. Okay, it means if it is a weak form market efficiency, that means everybody knows technical analysis, so you cannot make abnormal profit. Okay, using technical analysis. However, you can make abnormal profit using all this fundamental and private information. Okay, and if you make abnormal profit, this means the market is inefficient in terms of weak form. It is weak form inefficient. Okay, this is weak form inefficient. Weak form inefficient. Similarly, now here, so just go through this and see. Tell me if you have questions on this one. They will play with English only, and for that you need to attempt the questions. Then only you will get to know. This is okay. Hello.
Yes, sir.
You want me to explain anything?
No, got it,
It's
sir.
fine. No? Okay, fine. Okay. So this is easy to understand, but when you get the questions, you will be little confused because they will play with English. So that you will know only when you face questions. Okay. Then, so this is this topic always an important one. Okay. This page you should read couple of times. Very important one. Then moving
Okay,
on,
sir.
after this, these are all not needed. All these are not needed. This one, market anomaly, this term you should know. Basically, market anomaly means is something that would lead us to reject the hypothesis of market efficiency. That means it is going against the market efficiency. That is also anomaly. Anomaly means something that deviates from the common rule. Okay, anomaly means something that deviates from the common rule. Okay, something that deviates from the common rule. Okay. Uh, Data snooping or data mining. These are all important terms. Okay. Data snooping or data mining. Basically, what it means is mining data. That means creating data, gathering data, analyzing data. Okay, and playing around with the data till you get the report that you want, or till you get the output that you want. That is data mining or data snooping. That means examining the data in various forms and extracting the one that you require. That is data mining, or also called as data snooping. Statistically significant relation is found. Investigating until a statistically significant relation. That means till you get the output that you want. Okay. Till that time, you can study data in different angle. For example, you can study data, you know, saying like, if you want to prove that sales are happening very good, then you may want to, let's say DMart sales are happening very good, then you may want to check the data of only Saturday, Sunday. Or if you want to prove that sales are not going good, then you might want to check the sales of only morning. Afternoon sales might not be that good. Evening only people normally go for shopping in DMart, right? So this way you can study data from different angle. Or weekdays it might be very less sales in comparison to weekend. Okay. Then anomalies in time series data. So anomaly, as I said, it is something deviating from the normal behavior. So there is something called January anomaly. January anomaly means what? Every January in US, the stock market comes down. Initially, it comes down. Starting, why it comes down? Reason being, by uh, see, it's a finding that during the first 5 days, stock return, especially for small firms, are significantly higher than their rest of the year. During the first 5 days of January, stock returns, especially for small firms, are significantly higher than they are rest of the year. In an efficient market, traders will exploit this opportunity in January, and in so doing, eliminate it. And they eliminate the returns also. Okay. See, typically what happens is December ending. That means when Christmas comes, that's their biggest festival, right? So they tend to pull out money from the stock market, and then they go for vacation that time. So stock market comes down at that time because nobody's investing, everybody's pulling out the money. That is number one reason. Number two, over there the financial year ending is from 1st Jan to 31st December. What is the financial year date for us in India? Financial year is from
April till March.
1st
April
April
till, yeah, 1st April till
to
31st.
31st March. Okay, whereas in US it is from 1st Jan. Calendar year only is the financial year for them. So, whoever is in unrealized losses in the investments, they tend to book the losses. Why would they like to book the losses? Because if they book the losses, then they can show it in their tax return, and they will get some tax benefit out of it. So again, that will pull down the market. Okay, because more selling will happen, and also window dressing will happen. What is window dressing? Have you come across to this term before? Window dressing.
Yes. Yes.
Okay, yeah. So window dressing means what? Basically inflating the records in the income statement and balance sheet, Okay, so because that is the last quarter of the year, this is the last time of the year, so they want to increase all the profits. Why so? So that they can become eligible for bonus and other incentives, and to make sure that yearly basis company did very well, they tend to show maximum profit by inflating records. Okay, so based on all these reasons, uh, see, they realize losses for tax purpose and then repurchase stocks in January, pushing the price up, and window dressing as portfolio managers sell risky stocks in December to remove. So whoever is selling in December, then then January also that trend follows initially, and then later on they buy it, and then later on the price goes up. Okay, so this is something deviating from the normal rule, normal way. Normally, a stock market should function based on how the companies are performing, but these are all based on tax year ending, and Christmas, tax year, window dressing. Based on all these things, market is moving. So it is deviating from the normal rule. So all these are what market anomalies. Okay, market anomaly. Then momentum effect. What do you mean by momentum? What is overreaction? Overreaction refers to the finding that firms with poor stock returns over the previous 3 to 5 years have better subsequent returns than firms that have had stocks huh, that have over the okay. So what does this mean now? Overreaction effect refers to the finding that firms with poor stock returns over the previous 3 or 5 years have better subsequent return than firms that had high stock returns over the prior period. That means a stock which is the hero of this year might not be the hero of the next year, and the stock which has not done well this year, that those stocks they have got more probability to do well next year. Okay, that is overreactions. Because of overreaction, some stocks would have gone really up, and some stocks would have gone really down. And finally, then what will happen? Reversal will happen. These stocks will come down, these stocks will go up. Okay. Then momentum effect. Momentum effect means the stocks which are going up, it is expected to continue to go up. Which are going up, which is expected to continue to go up further. Okay, that is called momentum returns. Okay, momentum effects. Momentum. That means we say the stocks are in momentum. Okay. If you want to find any stocks which are in momentum, how you should find out, you should go to, like for example, you go to screener. Okay, I'll show now. If you want to find out momentum stocks, how will you do? You go to screener.in. So when you go to screener.in, you type any company, let's say uh, just like that, just to get into tips music or Reliance, any company you type. Okay, now here uh, go to uh, okay, I have to log in, I think. Hmm. Hmm. Under screens, go to create new screens. Okay, in this one you just type uh, last 1 month. Return over 1 month, say. return over 1 month, let's say more than uh, 20 percentage. Okay, return over 1 month more than 20 percentage, and okay, and then any conditions you can put. Let's say you want only those companies which are like 5,000 above, 5,000 crore above market capitalization. So market capitalization is more than 5,000 crore. Okay, and then run this query. You can change it to 7,000, 8,000, 10,000 also, up to you. So yeah. Now you see, now here can you see returns? So returns, so let me click here 1 month, actually last 1 month return. See this. So now 99% return this company has given. Suven Life Science, 99%, that is huge. Whereas its fundamental is not so strong. See, sales has come down. So this all what must be happening, some operator must be, playing with the stock. Someday they will dump all. So like this, these are all called momentum stocks, which are in momentum. Now within this, you can pick the stock that you feel is, you feel is good with fundamentals, and accordingly you can, you can then play around with the stock, and you can buy those stocks assuming the same returns will be continued. This is okay. Now here, if you want to search about any company, Shravani, have you seen this link before, this screener?
No, sir.
Okay, you have never used screener before.
No.
Okay, so you take this as the task. What you should do is you should search about this screener. Go to YouTube, just check, what is screener.in. It's a very, very important tool to analyze any stock. Okay, and also, just uh, open one account here today itself. You go to screener.in and type any company. Go to search, type any of your favorite company. Let's say something like as simple as DMart. So DMart. So Avenue Supermart and DMart are same. So you go here and then try to read all this. See, you will get plenty of doubts. Don't worry. You need to go through that path only. Okay, getting doubts is good only, but not at all going through this link is bad. Okay, just mark all your doubts. You can keep it with you. Okay, just mark all your doubts, because when we will do FSA topics, that time all will be sorted out. But at least your mind should get questions. Then only when you will get the answers, you will feel like, okay, I have understood something. But if the mind is not getting any questions only, then it is not good. Then just go through this. What these are all the competitors of DMart, and then uh, this is the income statement. So what they have given information over here, just go through it and spend how much ever time you want. Okay, this is one task that you have to do. Subhajit, I believe you know this one, right?
Yes, sir.
Yeah. And another task that you both should do, in case if you are not doing, you go to YouTube, and in YouTube just type any company's con call. Okay, any company's con call you may type. So just type that company's name and then type con call. Okay. Just type, say for example, if I say DMart, okay, uh, like see, now so here I just typed DMart con call. Where is DMart con call? Like this, these are all CNBC channels. So 3 weeks back, some news, something has happened. Just listen what people are saying, what experts are saying, news channel. This kind of news channel, slowly, slowly start watching all this. This is the con call. This you should listen. This is but little older, 10 months older. You can go for something latest one. Uh, latest Avenue Supermarket, right? What is that Avenue Supermarket? So watch this kind of, all this. See, this is hardly for 2 minutes. So watch all this kind of news, okay? Because they directly will be speaking. Where is there? You should watch this one, con call, but this is a little older. Any other company you can think about? I don't know why it is not there. It should be there. Any other company, easy company, let's say Hindustan Unilever, HUL, con call, uh, con call, or earnings call also you may type. 1 month. This one you should watch. Okay, this one. Got it? This one you listen. It will be terribly boring. This is for almost like 1.5 hours. At least listen for 10-15 minutes. You will not be able to hear it. Your ears will start bleeding because it will be terribly boring. Okay, but try, because this is where your personality development will happen. Okay, but slowly, when you will start understanding all these things, then you will get used to it. Then you will start appreciating things. You would be interested, even in spite of this being very boring. You will be interested to know what they are speaking, because this information you can convert it into money. Okay, in this information you can make wealth out of this informations. So like this, any company you type in YouTube and type con call and go for the latest one. Latest means 1 month, 2 weeks, like this you search. 1 month, 2 months, maximum well, maximum last quarters one, 3 to 4 months. Con call, you just like that click and then try to listen. Okay, any of your favorite company you do like this, you will get to learn plenty of things about what is happening within the company. Okay, fine. Okay, so now we were checking. See this one. These companies are in momentum. So when these companies are in momentum, we can expect this momentum to continue further as well. Okay. So out of this, any company that you have heard, any company? Have you heard any company? Just see on the left hand side. See, all these companies names are given. Anything you heard before?
Yeah, I've heard of e-clerks.
Mhm. Mhm. So you can go to that company. Here, if you click, you will get to know how this company is doing, what this company is doing, what has been the performance of this company, balance sheet, all these things you will come to know. And if you want to read that con call, that I told you to listen. No? If you like reading, you find it very boring to listen. You click here, you will get, see, this is the transcript. Transcript means in written form. Okay, that con call only, it will be in written form. So here it's like a conference call. Okay, all analysts will ask questions, and then this CEO will keep answering. Okay, so you may read this also, whichever you feel convenient, but start somewhere. You don't have to give you a perfect start, but start. That is more important. Okay. Any other companies you heard up after Eclipse? No company. Okay. But there are so many well-known companies. If that's why you are not tracking, so if you are in touch with the market, you will know that many companies are known to you, because now you are not in touch, you are not getting to know. Okay. Sorry. Angel One, have you heard?
Yeah.
Then Reliance Infrastructure. This is cable company. Okay. Then yeah. So these are all the companies. Okay. Motilal Oswal Financial Services. Have you heard?
Yes, sir.
Just 1 minute. Hold on. Okay. Huh. Okay. Now we'll just continue. So try to become practical in the market as much as possible. Start reading business newspapers, start watching business news channel, and you can ask me all questions from there as well. Not necessary that you have to ask questions only from Schwezer and the curriculum. Feel free to ask any newspaper articles doubts also, okay? Because finally I would like to see you as a person who knows about the market, not that only you know about CFA subject. That is not the intention. Otherwise you will have the certificate, but you will not have the personality to even talk to the interviewer then. So that's why it's very important to build up that personality. Okay. Yeah. So now we'll come back to this part, momentum. So I showed how to find out momentum stocks. So these momentum stocks means which are going up, and so it is further expected to go up. Okay. Yeah. Then uh, anomalies here. Small cap companies are outperforming large cap. That is also anomaly, because normally large companies should be growing faster, but then smaller companies tend to grow faster than large company. Okay. And then value effect and value stocks and growth stocks. Value stocks means investing in those companies which are undervalued. Okay, undervalued. That means the price is lower than their intrinsic value. That means if their intrinsic value is 100 rupees, that means it should be 100, but it is trading at 80. That means this stock is what? Undervalued. Undervalued. Okay, or similarly, it should be 100, but it is trading at 120. Then this is overvalued stocks. Okay. Then growth stocks. Growth stocks means stock, which has got tailwind. That means it is growing very fast. Examples of growth stocks are like EV stocks, electric vehicle stocks, then renewable energy stocks, renewable energy stocks. Okay. Then closed-ended fund, you ignore this one. We will be doing this in alternative investments. Okay. Yeah, this all you can afford to ignore. Doesn't matter. Behavioral finance is very, very important one. This one. Wherever you see behavioral finance, you should be reading that. Because see, you can make, if it is see what a person can make money in the stock market not because of his technical intelligence. If you don't know today, tomorrow you will come to know. It's not a big deal. But behavioral finance, you will not get easily. That means, what is your behavior towards finance? For example, you should have patience when you are investing. Now, patience, you can write a book or you can read a book about patience. That doesn't mean you are a patientful person. Now, after reading all the books also, still you will be very impatient. It is possible, correct? So such qualities you will not get behavior. Whereas technical intelligence you will get, if not today, tomorrow you will get. That's it. So that's why behavioral finance is playing a lot of is extremely important nowadays. Okay. So loss aversion, what sort of behavior is this? Loss aversion means it is the hypocritic condition of a human being. Like I will accept profit, but I will not accept losses. That means what? It's a hypocritic mind, that you should be like, if you are ready to accept profit, you should be ready to accept losses as well. But you are not doing that. What are you doing? Your mind says that, look, I will enter into the stock market, but I want only profit, not losses. Okay, so that is called as what? That is called as loss aversion. Loss aversion, the tendency of investors to be more risk averse when faced with potential losses. Okay. Investor overconfidence. Normally, any investor they can be overconfident. That is possible. Herding mentality. Herding mentality means uh, herding mentality means going with the market, going with the flow. Whatever majority people are going that side only. Okay, that is called uh, herding mentality. Okay, yeah. Then that's it. Rest is all fine. Then types of overview of equity securities. Okay, so proxy voting. Proxy means having someone else vote as they direct them on their behalf. That means you are voting for somebody else. Like when you are playing the role of a fund manager, portfolio manager, you might have been given right by your client to vote on their behalf. Like mutual funds vote on behalf of the investors. So that is proxy voting. Now, statutory voting and cumulative voting. These are two types. Statutory voting means each share will have one voting right. So in a statutory voting, one share, one voting right. So say for example, you have 100 shares. So 100 shares means 100 voting rights you will get. Hundred voting rights. Okay. So when you have 100 voting rights, so here, uh, see for example, consider a situation where a shareholder has 100 shares. 3 directors will be elected. Achha, one second, wait. This one. In a statutory voting system, each share held is assigned one vote in the election of each member of the board of directors. Okay. Each share is held. Each share held is assigned one vote in the election of each member of the board of directors. Okay, that means if there are three, you know, three auditors being appointed, auditors or directors, anyone being appointed, then you can vote, one here, and one here. Okay, three vote you are getting. Three as in because you have 100, so 100 here, 100 here, 100 here. This is called statutory voting. Cumulative voting means cumulative voting means this directors are being appointed, right? You have the right to accumulate all 300 and put for one person. So you can put more weightage. This is called cumulative voting. Okay, this is called cumulative voting. Uh, yeah, this is called cumulative voting. Okay, then preference shares, I think I have already discussed, right? Types of preference shares, cumulative preference shares,
Yes, sure.
participating,
Yes, sir.
and convertible. All this we have discussed. Then this is a small theory. This is again a part of alternative investments, but okay, we'll just quickly discuss. See, venture capital means capital provided to firms in their early in their life cycle. Okay, it's all newborn, smaller companies. When you invest into such kind of, when a company is investing into such kind of companies, smaller one, then it is called as venture capital. Then there are some other terminologies. LBO means when you are borrowing to buy a company, then it is called as LBO. LBO means leveraged buyout. Leverage refers to borrowing. Okay, leveraged buyout. That means you are borrowing to buy a company. That means you are taking that much of risk because you believe you can transform the company and then you can sell it and you will make huge profits. Okay, so investors buy all of your firm's equity using debt financing, leverage. If the buyers are the firm's current management, the LBO is referred to as management buyout. Okay. So current management is only doing, say for example, you see in Bharat Pay, what happened? Existing co-founders and other managers, they have removed Ashnir Grover out. Ashnir Grover is the founder of Bharat Pay, but all other co-founders or managers, they have removed him, and they are now controlling the business. That is called as management buyout. Even in the case of Byju's also, now court cases are going on, but then right now they don't have control. Byju family, they don't have control with the company. Okay, so that is, these are all like management buyout. Management is trying to control. Okay, management buyout. Then private investments in private public equity. This is like metro being built on government land. That means private investment is happening in public equity. Private investment is happening in public equity. Okay, this is called pipe. Private investments like metro you can think about. Then foreign equities and equity risk. So here, this one, DR, depository receipts, you need to know. Depository receipts, actually, I have already made a video. I'll just send that before I forget. Depository receipts. Depository receipts. depository receipts. So now what is depository receipts? Okay, let's see. Let's say you are investing, this is US and this is India. Now, if US investors, assume for a minute that Infosys is very popular in US. Infosys is an Indian company which is popular in US. So people like Infosys company a lot. Just like in India, Facebook is popular, Apple is popular, Microsoft is popular. So if these people want to buy Infosys company shares, then it becomes a foreign trade for them, right? International investment. So what sort of problem can they face in these international investments? They can face problems like what? Like currency differences, then what else coming to your mind? Uh, Timing differences, then what else? Uh, uh, More KYC, more stringent KYC. Okay, so these are all some of the problem, or more costly also it might be more costly. So these are all the challenges that they are facing in an international investments. So now this is a problem. So now JP Morgan is thinking to convert all this problem into opportunities. So what JP Morgan will do is, so uh, JP Morgan will buy Infosys company shares in its name, JP Morgan's name. Okay, say for example, it is trading. See, say for example, $1 is equal to 85 rupees, and assume Infosys is trading at 85 rupees. If Infosys is trading at 85 rupees, and if JP Morgan is buying that and bringing it to US, so what will be the price of one share? It should be $1, correct? Now, when it is $1, quite possible that it might send negative sentiments to the investors that it might be a penny stock. They might think that it is only $1, very less. It might be a penny stock. So, in order to market it in a better way, what they will do, they will what will they do? They will club multiple shares together. Say, for example, instead of one share, they will buy 10 shares. So $1, 85 rupees. So 10 shares will become 850, and that will become what? $10. So when they bring it over here, they will club 10 shares and they will sell 10 shares as one share, and that is equal to $10. Okay, 10 shares as one share, and that is equal to $10. Okay, and this, now see, 10 shares as one share is not making any sense. That means I'm saying 10 shares is equal to one share. Now that is not making sense. So we have to give a new name to these 10 shares. So this 10 shares, they gave a new name as receipt. It's a receipt. Now when JP Morgan is doing this work, they are called as depository bank. Depository bank. Depository bank. So uh, depository bank. So because this receipt is issued by a depository bank in America. So this receipt is issued by a depository bank. That means what? JP Morgan in America. So this is called as ADR, American Depository Receipts. So what do you mean by ADR? ADR, it represents It represents shares of non it represents shares of non-American companies being traded in America. Okay. Okay. It represents shares of non-American companies being traded in America. Clear with the term ADR?
Yes, sir.
Okay.
Yes, sir.
Yeah. Now these ADRs are of three types: level 1 ADR, level 2 ADR, level 3 ADR. Level 1 ADR is called as unsponsored ADR. Level 2 is called as sponsored ADR. Level 3 is also called as sponsored ADR only. So level 1 unsponsored ADR means unsponsored ADR. Uh, Unsponsored means JP Morgan is doing all this receipt work and Infosys has no say in it. Infosys is least worried. Even Infosys's permission also was not taken. And Infosys is okay only because Infosys permission is also not needed. So Infosys has got nothing to do. Why? Because everything is handled by JP Morgan only. Okay. So this is called unsponsored, where the underlying company has no legal agreement with the depository bank. Okay, it is unsponsored. So here, so it is trade, yeah, and it is traded over the counter. It is not listed. It is traded over the counter. Traded over the counter. Over the counter means what? That JP Morgan will directly identify such kind of investors and they will keep doing buying, selling with them. There is no stock exchange involved here. It is happening over the counter. Over the counter. Okay. And yeah, and then sponsored is now. Now imagine Infosys is now thinking, look, it seems like I'm very popular in US. Let me do one thing. Let me do one thing. So because I'm popular in US and my clients are also in US, I will go and list my shares in the stock exchange so that these people can buy and sell from the stock exchange itself. So JP Morgan is Infosys is listing their shares. Infosys is listing their shares in the US stock exchange. In the US stock exchange. Okay, that is called level 2 sponsored. Then level 3 sponsored is where Infosys is raising capital as well. Okay, so here because they are listed, then they will start filing SEC filing also happens. SEC filing means what? SEC means Securities and Exchange Commission. That means the regulator of US. So they will start filing all the reports as per US regulator. Here Infosys, third one, Infosys raises capital. Infosys raises capital and lists their shares. Infosys raises capital and lists their shares in the US stock exchange. Okay, and lists their shares in the US stock exchange. So this one, level 1, level 2, level 3. This 144A is not required. Yeah. SEC registration is required here as well. Okay, SEC registration is required here. SEC registered here also. Then SEC JP Morgan will register this. SEC registration. Then what happens is now this is how it was started. Okay, I'll just show one ADR practically. See, all you have to do is go to nyse.com. That means New York Stock Exchange.com. So when you go to New York Stock Exchange.com, go to search. Here, go to search, type Infosys. Actually, Infosys ADR is existing. See this one, sponsored ADR. Okay. So Infosys actually raised capital from US and listed their shares in US. Okay. Now I'm not sure if the market is open over there. Okay. So, but still, I think you are still getting to see the data. Okay. So it is trading at $18.19, and all these are your Infosys details. It's fine. Like this, there are many companies which are listed in US. Okay, other companies like HDFC Bank. Can you see here? See this HDFC Bank. Okay, then SBI is also there. Is it there? SBI Bank. SBI is not there. Okay, ICICI would be there. ICICI Bank. Okay, so two shares are representing one ADR. Okay, then Wipro, like this, many companies are there. Wipro is not there. Wipro. Okay, yeah. SBI is not there. Anyways, understood. These are all ADRs. Other companies apart from India, if you want to see, have you heard Alibaba company? Alibaba,
Yes, sir.
Chinese
Yes.
company. Yeah,
Yes.
Chinese company. Okay, this is a Chinese company listed in US. Alibaba. Okay, this is ADR. Now, in ADR was started somewhere in 1949 somewhere. It was started by JP Morgan only. Then it became very popular. Now, once it became very popular, even other countries started copy pasting it. Now, in other countries, how it worked, like same Infosys, suppose Infosys or any company, let's say Aditya Birla. Now, if this Aditya Birla company from India, it goes to UK or Europe and lists their shares, they gave listed their shares. They raised capital and listed their shares. Raised capital and listed shares. That time it came to be called as GDR, Global Depository Receipts. They changed the name from ADR to GDR. But GDR is very common, Global Depository Receipts. It is not giving an idea about which country where it is getting listed. Like for example, ADR is giving an idea that non-American companies shares being traded in America. This one is Global Depository Receipts. Okay, Global Depository Receipts. So, but this is not giving a clear picture, like exactly which country. So, what happens is they started giving specific names also. For example, this is called EDR. Okay. By the way, GDR does not have like level 1, level 2, level 3. All are sponsored only. That means all are level 3. That way you can think. All are sponsored. Sponsored GDR. Okay. So this is EDR means European Depository Receipts. That means non-European company shares being traded in Europe. Then Japan. then this is Japan depository receipts. That means what? Non-Japanese company shares being traded in Japan. Then what should be for India? It is no idea. IDR, non-Indian company shares being traded in India. Okay, non-Indian shares. Hello, you both can listen, right?
Yes, sir.
Yes, sir.
Yeah.
Yes.
So
Noted.
non-Indian shares companies being traded in India. Okay. So actually there was only one IDR which came somewhere in 2010, and then I think before 7 8 years back, that was standard 10 in 2010 it came. That was Standard Chartered Bank. Standard Chartered Bank is what? An UK company. So being in India, you can buy and sell Standard Chartered Bank in Indian rupee, but they were not happy with the rules and regulations framed by India, and so they delisted their shares. And after that, no other company came to India, through idea. Okay, so we don't have any idea right now, but many GDRs are there. Aditya Birla is listed in Europe. Like this, many other companies are there. Okay, so this is about ADR and GDR. Okay, clear till here?
Yes, sir.
Okay, fine. So here, this part is important. Trading location. It is traded over the counter level one, level two. New York Stock Exchange, Nasdaq, and American Stock Exchange. These are all exchanges name in America. SEC registration is yes. So here, ability to raise capital is there only in level three. Okay. So 144A means privately placed. That means privately, most require US registrations and exchange commission registration, but some are privately placed. Okay, without registration. That is following 144A or regulation S receipts. Okay, this is okay. This 144A, if you ignore also, it's fine. But basically, you should know what is ADR, what is level 1, level 2, level 3 ADR. Okay, fine. Then after this, all these are not required. Yeah, okay. I think then we can begin from this one next time then. Okay, 42
Yes.
point G, we will begin from next time. Okay, so we'll stop now here, and I'll send you the link in some time. This video's link. Okay, fine.
Okay,
We'll,
so
we'll stop
Okay, sir.
here. Okay, okay.
thank you, sir. Thank you.
Thank you, sir.
Yeah, bye. Bye.
Bye.